Great. Thanks so much, Michael. I appreciate it. And thank you all for taking the time out of your busy days to come and hear a little bit about what we have to say, some perspective on the market and the benefits of diversified alpha, and also the ways in which Unlimited is creating products so that all investors can get access to high quality, institutional level diversified alpha in a tax advantage form through an ETF. I probably don't have to tell all of you that this has been one of the most challenging cycles that we've ever seen. We've seen the largest duration sell-off in pretty much history, a dollar surge, a commodity rally, all of which with a stock decline. When you put it together, this cycle has looked unlike any other cycle that we've experienced. And many of the lessons that we've all learned as investors, particularly around how to diversify in a down market environment, the things that we've learned over the last 20 or 30 years, for instance, holding bonds against stocks, have failed to work in this environment. And so it's been a very difficult time to find a source of high quality diversification that could benefit client portfolios. What's notable, however, is that diversified alpha during this period has held up pretty well. What you see in this chart is a scan across all the major asset classes and stock sectors over the course of 2022. And what you see here is that hedge funds, there in the gold, put together a diversified portfolio of hedge funds, have only slightly underperformed relative to all of the other asset classes that are out there. Pretty much other than holding your money in cash or getting the commodity bet right, hedge funds have outperformed pretty much everything. And that's normal during these sorts of drawdowns. Hedge funds are often able to navigate difficult cycle environments because they're in a position to be much more flexible and agile with their allocations than many other managers. The ability to go long and short, the ability to move between growth and value in different geographies gives these funds the flexibility to be able to effectively navigate, the changing market conditions. And so at Unlimited, what we've done is we've built a technology that allows us in real time to track the positioning of these funds. We use machine learning technology combined with our decades of experience in the hedge fund industry and our experience building a wide variety of hedge fund style strategies. And we take that understanding and build a process, a machine learning process that looks at the pattern of returns that we're seeing from major hedge fund styles and hedge funds themselves, compares that to a plausible set of positions or exposures that funds might have on at each point in time, and then can basically translate that into a set of long and short positions in 30 to 50 low-cost index ETFs. And from that technology, we have the ability to, in real time, be able to see what these hedge funds are doing. And ultimately, what we do is take that understanding and package it up into an ETF. But I think it's particularly useful to see through the 2022 context because it gives a real lesson into how the technology works, but also an understanding of how hedge funds have been able to navigate this so well. It was very interesting to see as we were coming into the start of the year. This was before the war, just when the inflationary pressures had been building, how hedge funds in aggregate had done a really good job positioning for an inflationary tightening cycle. On the left, you see in the blue bars, their positioning coming into the start of the year across major asset classes, with the gold marks being their sort of traditional or average positioning over the course of the last 20 years. And what you see here is even coming into the start of the year, hedge funds were starting to position against position for an inflationary tightening cycle. So starting to reduce their duration exposure and increase their commodity exposure. And then under the hood, while aggregate stock cash allocations hadn't changed that much, what we were starting to see from equity long short managers was a shift in terms of their defensiveness, recognizing that a tightening cycle would create a hit on aggregate stock prices, and so they moved to a much more defensive position. So whereas a few years before, they had been very long growth and generated substantial returns from that, they started to cut their growth positions and increase their value positions. This put them in a high quality defensive position in order to navigate the difficult environment that they saw through the course of 2022. And then through that time, they've only become essentially more defensive and well-positioned for this inflationary tightening cycle. What you see here is a recent read that we have on hedge fund positioning in aggregate. What you see here is on the left-hand side, what you see is a significant shift in their positioning in the bond market. Whereas hedge funds in aggregate have been typically long bonds over the course of the last 20 years, they're now holding in aggregate short credit positions or short duration positions, which is a pretty significant position, and still holding long commodity positions. And then over here on the right-hand side, what you see is a continued shift in their equity portfolio, in the shape of their equity portfolio. And what that looks like is now at this point, short growth stocks as well as long value stocks, and really cutting positions, cutting risk in general across the board. When we compare the total amount of risk taking that hedge funds are taking today relative to the last 20 years, they're running at about the 10th percentile of overall risk taking, which is, I think, a quality testament, to just how uncertain this market environment is. And that is what we're able to do as we go through the process of evaluating, using our technology to evaluate and understand what type of positioning these funds have on at each point in time. And so at Unlimited, what we've done is we've built this technology and we've taken it, and what we've done is actually stress tested it through time to see how well this technology is able to track the returns of hedge funds, the aggregate hedge fund industry over time. And what you see is by using machine learning technology that we've developed and comparing it to the patterns of returns that we're seeing, what we're able to do is infer pretty well what that pattern of returns is for hedge funds. On the left-hand side, what you see in the blue line is the rolling 6-month returns of the gross of fees returns of the hedge fund industry, which we construct by putting together a number of different indices. And in the gold is using that same exact technology in a fully out of sample way in order to track what the positioning is of hedge funds through time. And based upon that, you can see that we've been able to, using this technology, are able to track the positions pretty well. And what that technology does is it allows us to infer, as I said, in a set of 30 to 50 low-cost index ETFs, the positioning of hedge funds at each point in time. And then we can translate that into long and short positions in real time. And so on the right-hand side, what you see is basically the positions, the underlying individualized positions that are behind those sort of aggregate views that you saw before about what hedge funds are doing. So meaningfully long or meaningfully short duration through this period, as well as sort of long cash and long defensive sectors. What this also allows us to do, this approach, this machine learning approach, is also meaningfully different from much of what is in the market today. Typical, classic hedge fund replications have tried to either track specific types of strategies, or they've tried to track they've tried to track the beta in the alpha, because that's a lot easier to do more structurally than it is to try and pick up the alpha returns. But here at Unlimited, what we've built is a technology that has the ability to track the positionings in relatively real time. And what that allows us to do is to be able to generate or replicate a lot more of the alpha positioning of these managers, the alpha returns of these managers, than other previous hedge fund replication strategies. And so on the right-hand side, we've taken the gross of fees returns of the hedge fund index and broken it down into its various pieces: cash, beta, smart beta, and alpha. And you can see hedge fund managers do a great job actually generating a fair amount of alpha over time. The real problem with hedge fund managers is this gold bar, which is the fees, right? And I'm sure all of you understand and are familiar with the type of fees that the type of 2 and 20 fees that these funds charge, which, what they do over time is they basically take nearly all of the alpha that they're generating, leaving individual investors with not much better than index returns. But by using technology, we're able, at Unlimited, we're able to replicate these returns in a much more low-cost way. And so while we've created a pattern of returns, which you see here on the left-hand side, a similar breakdown, a pattern of returns or source of returns that's very similar to what you see in the aggregate hedge fund industry, what we're able to do is we're able to charge a much lower fee. And by putting it in an ETF structure, it is a much more tax-advantaged structure for those investors who are taxable. And so that gives you a little bit of background about what's going on in the hedge fund community and what's driving their returns during this period. As part of this, we just give you a sense as to what we're doing in Unlimited. We're about to launch our first index replication ETF, leveraging this technology, which seeks to replicate the returns of the gross of fees returns of the hedge fund index. And as part of that, we've put together a unique launch vehicle, which for the first $20 million of commitments offers a 20% share of the total AUM management fees, which targets a return of around mid-teens returns with monthly liquidity. And so for those folks who are interested in what we're doing here at Unlimited, creating this index replication ETF, we'd love to talk to you more about it. And for those who are accredited or institutional, you might be interested in this seed vehicle that we're raising for. About a little over halfway through raising for this seed vehicle. And if folks are interested, they could certainly reach out to Michael with their expression of interest, and he could circle back and let us know about that interest. So I'll pause there. I don't know if we've got any questions from folks who are around.
So there are some questions. How do hedge fund managers typically perform during recessions?
Yeah, I mean, hedge fund managers, the interesting thing about holding a diversified portfolio of hedge funds is that what you see over time with that pattern of returns is a type of return pattern that is basically equivalent to the S&P 500 returns, something like 9 or 10% over the course of the last 20 years, with actually less than half of the volatility of the S&P 500. And what's interesting about that is that the way that hedge fund managers are able to generate those returns is, in particular during down periods, hedge fund managers typically are very good at limiting downside risk. And then during upside periods, generate good but not exceptional returns. And what that means over time is a much more consistent return stream than what you typically get holding an S&P 500 position.
Okay. Next question is what we are seeing common.
Say that again.
So, all right. So the first question was, how do hedge fund managers typically perform during recessions?
Yep.
And then the same person has a subsequent follow-up. Is what we're seeing common?
Is what we're seeing today common in terms of hedge fund performance? I think this type of pattern of return, if you go back and look at 2020, or if you look at 2008, what you see, or even the early 2000s, what you see is that, I often describe hedge fund returns as being covered in the storm. And so what you see is that in each one of those instances, it's not like a diversified set of alpha is able to provides meaningful upside during downturn environments. But what it does is it constrains or it limits the downside meaningfully during difficult market environments because of the flexibility that the asset managers have to cut risk and move to more defensive positions and hold short duration, et cetera. And so that really is how these managers are able to generate high quality, lower volatility returns, is by being able to navigate the environment effectively when you see a downturn like this.
Okay. So I also want to encourage people to use the Q&A function that's in the bottom of the Zoom toolbar. You can pop your questions in there, but just to take the next question. Why not just concentrate on strategies or managers that you expect to do well?
Yeah, I think it's an excellent question, and one that we get a lot. A question about whether people read global macro managers have done particularly well, or managed futures managers have done particularly well through this market environment. And I think one of the challenges of finding, there's a real challenge basically of finding which strategy is likely to be successful in the future. If you look across hedge fund strategies, when I talk about equity long, short, global macro, fixed income arb, managed futures, et cetera, what you see is basically all the strategies are pretty good over time. They're all generating alpha, and they're all generating high quality, consistent returns over time. The thing is, it's very hard to know on a forward-looking basis which one of those strategies is likely to outperform versus which one is likely to underperform. So take this year, for instance, basically global macro coming into this year has had basically a decade of relatively modest performance, whereas equity long short has had a decade of very good performance. If you were only looking at things on a backward-looking basis, you would probably have underweighed global macro relative to equity long short. But it's been critical in this environment to have that sort of global macro manager exposure through this period, which has driven great returns to help offset the modest underperformance that you see in equity long short managers. And so when we think about at Unlimited, when we think about what generates the most consistent return over time, it really comes from creating that diversification of different asset strategies, different manager strategies, because it's very hard to know on a forward-looking basis which one's likely to be better than the other. I always like to say diversification is certain, and your confidence in picking winners is highly uncertain. So much better to bet on diversification than to try and pick which ones are likely to win. The one other thing I'd add to that is that strategies like managed futures have gotten a lot of attention in the course of the last couple of months due to the strong performance. I think it's important to recognize how those strategies have typically performed after periods of outperformance. We have some commentary on this on our blog at unlimitedfunds.com, where we look at how managed futures have done following outperformance. And what you see is typically in the 2 years following a period of outperformance, a strategy like managed futures actually underperforms a diversified pool of assets. And so that's why we really are suggesting and building a strategy and a structure that is highly diversified, not only because it generates better returns, but honestly, it's a lot less work than having to try and pick a particular strategy.
Absolutely. So how quickly can you get information about hedge fund performance in order to track what they're doing?
Yeah, I think that the industry's come a long way. I mean, years ago, it used to be that you'd sort of get quarterly or annual performance, but these days, there are many industry aggregators that are that basically bring together the monthly performance of hedge funds within the course of a couple of days after the end of a month. So within, say, 3 or 4 business days following the end of a month, we have a pretty good sense of how the community of roughly 3,000 hedge fund managers have done in the previous month. And at that point, we're able to generate our views, which portfolios basically best explain that pattern of returns. So in general, by using this technology, we're a few weeks behind what the hedge fund managers are actually doing. Now, I put that into context of the broader sense of how these managers typically work. And what we're really trying to do here, in many ways, is to try to extract the wisdom of the crowd, right? By understanding the aggregate hedge fund positioning, we're extracting the wisdom of the crowd. That set of views typically takes meaningful amounts of time to evolve. So, back in early 2020, hedge fund managers were very long growth and tech stocks. And now coming into this year, they were long, they then became long value stocks relative to growth stocks. That was a transition of understanding or of thinking that took 18 months to do. So the fact that we're a few weeks behind what the managers are actually doing is not that big a deal in the scheme of things. And what I'd say is, in comparison, it's always critical to think about is what you're paying for what you're getting. And a big part of the benefit of using an index replication ETF rather than having the fund positions themselves is it comes at a much lower cost. It comes with daily liquidity. And it also is in a package that is much more diversified than pretty much what any individual investor can do if they're directly investing in hedge fund LP positions.
So, Bob, do you mind if we talk a little bit about the opportunity that you have and
Sure.
What that opportunity looks like? So you're raising $20 million in seed through a GPLP structure, correct?
That's correct. Yes, it's a private vehicle for accredited investors and institutional investors who are interested in getting both exposure to the ETF as well as a share of the total AUM management fees. And so it really is. It's like a it's like an exposure to the strategy itself plus like a GP kicker on top of it.
Got you. So when you say term, you mean that you get the fees for 5 years, or how does
yes,
that?
the structure is that the investors in the seed vehicle would get the fee sharing structure for up to 5 years. So for instance, if the way it's constructed, if a person were to put in $1 million and the AUM, the total AUM of the fund was $1 billion, then they would receive an extra $100,000 per year in fee sharing in addition to the returns of the ETF. The idea here being we're sort of targeting mid-teens return for investors over time in the vehicle. And then, of course, the way we've got it structured here is that it has monthly liquidity. So if for whatever reason an investor would, it's an ETF, we can, there's no reason to have meaningful lockups here. And so if an investor in the seed vehicle, say 2 or 3 years from now, finds another opportunity or for whatever reason is no longer interested, they have monthly liquidity. This isn't a 5-year lockup. And then if they are to reduce their position, then they simply just get a reduced amount of the fee share.
Okay, I got that.
Just I can answer that that question about the 250K investment. It's just prorated. Everything is prorated against that general point of it's basically $20 million for a 20% fee share. So any investment that is, it's just basically prorated on that basis. So you should experience a similar IRR in aggregate.
Got you. Okay. So what I see very interesting is your liquidity. Liquidity is monthly. That's not typical of a hedge fund structure, really, is it?
No, I mean, most early, it's totally atypical for a GP style stake in a seed vehicle for a hedge fund style structure. Typically, the way that would work is you get economics that are not much different from this, but you'd be locked up for 5 years. And so instead, because we have this ETF structure, we have the opportunity to basically offer the liquidity. We can offer both the high quality returns as well as the liquidity because it's in an ETF, because our structure is an ETF structure. The one other thing I would add is that we can also preserve a fair amount of the tax advantage through this structure, since we can distribute the ETF to investors at the end of the 5 years. And they can, rather than distributing the cash, which means that they can have the opportunity to sell, assuming that they've held it for more than a year, the opportunity to sell the assets for, at the capital gains tax rate, assuming that they're taxable.
So if people want to have a conversation with you about the seed, what's the easiest way for them to get in touch with you? Do you have a slide on your presentation that you can just display that, or?
Yeah, they're more than welcome to contact us at info@unlimitedfunds.com. That comes right to me. Or you can email me, bob@unlimitedfunds.com. And I'd love to set up time to chat with folks who are interested in this vehicle.
Absolutely. So what I would like to, just remind people of is there will be an email coming out with a recording of this presentation. I will supply contact information. There's also materials listed on the flyer marketplace. If you have any questions about the product, if you have any questions, I'm happy to get you the answers directly or make the direct introduction to Bob. So Bob, I want to thank you for taking the time to be on today, and I look forward to the progress and working with Unlimited to make this launch a success.
Great, thank you so